let's talk to them about the real life scenario. I know you've got a couple clients, I've got clients, more than a couple, but you've got a client in particular who started one of these plans when they were a little bit younger. Just for the sake of the conversation, we're going to call him Billy. Billy started this plan when he was younger. Since then, and I'm probably talking more to your client Billy, who owns the landscaping business, that started this plan when he was younger. Now he buys all of his vehicles, he buys all of his equipment, and I believe he has some real estate property. Give them like a real life example of somebody who's using these life insurance policies for the infinite banking concept, or to go over and have the ability to loan their own money without having to go to a bank, pay their self back, and inject some steroids into the plan. Give them that real life example.
Yeah, absolutely. I mean, and the big part of that is being able to leverage dollars and utilize those dollars for other asset opportunities. And this is kind of what we're talking about. It's that money in motion concept, meaning we want to keep money moving to force action in terms of gain, growth, additional asset plans, versus we're just going to contribute and hope that a dollar amount accumulates to this number that we hope is the desired number we need to retire. So in the example that you're describing with Billy, he was a younger gentleman, probably 29 years of age, somewhere in that neighborhood, when he first started participating in a whole life plan. Little hesitant, I will say. He didn't believe in the value of the plan based on things that we're describing here today, becoming your own banking system. One of those things where it's too good to be true kind of ideas. So he was still doing venture wise into a lot of different asset positions, but he had young family. He wanted to make sure they were protected. So he understood that aspect. So that's really why he got involved in doing this from the beginning. And basically was, hey, I'm going to learn as I go to see, is this really what you claim it states it's going to do? So fast forward a couple years, he decides to leave the position that he was doing on a full-time basis, and he was doing kind of landscaping through summer months and doing those kinds of things. And he decided to walk away from his position and go into the landscaping business for himself full-time. And by doing that, he needed capital. So capital for the business, employees, equipment, those types of things. So what he did is he called me up and he said, hey, do I really have cash in my policy that I can exercise? The answer was yes. And here's why. He was not only doing, and you can structure these plans any way you want. This is why it's important to make sure that we're having conversations with individuals to truly determine what are they trying to accomplish, not just short term, but long term, so we can devise a plan that really fits their formula. So what he wanted to do is he wanted in essence less death benefit, more cash going forward. So in structuring the plan in that fashion, he's paying a monthly premium, but you're able to actually exercise additional monies. This is the steroid that you were referring to, Will. He decided that he wanted the ability to add dollars to the plan in the future if he had the ability to do so from a financial perspective. So I built the plan in that fashion. He had a premium that he had to pay per month, but per year he had a maximum that he could add into the plan without having to go back further into underwriting. It was just the nature of what he could do. He started exercising that, and we call that a steroid, to your point, Will, where he's adding additional dollars above the premium because he has disposable income that he wanted to put in there that he knew was growing tax-free, and he wanted to build this system for himself to exercise. So sure enough, he walks away from his position. He's starting his landscaping business. He needs capital. He has the cash inside the plan because he was maximizing that opportunity over and above his premium that he was putting in that steroid of additional cash to accelerate cash availability in the future. So we fast forward, he decides he wants to do this. We take cash out of the policy. There's his capital to do what he needs in the short term to start his business with equipment and just a couple of employees to get things rolling the way he wanted it to go. Fast forward again, he pays himself back all of the money that he had taken out of the plan. He pays it all back to himself. He doesn't lose the earning power of that dollar while he was borrowing against it. He still continued to grow the cash inside the plan. He pays himself back through the business, which is also a potential tax deduction to the business because he has taken, in essence, a loan so you'd have to work with a CPA to make sure how that works, but he can then take, because if there's interest that's accruing, there's some possibilities for some tax deductions. I don't want to get too deep in that, but that's another segment that we can talk about. So he then pays himself back. Not more than a year later, he comes back and he's in a situation where he wants to expand his business even further. He has a building opportunity to purchase to help expand his business even further. He comes back, he needs the capital again. He now has more cash in the policy. He takes it out again, more this time, puts it in there, buys the building, helps purchase the building with the down payment through the cash of his policy, doesn't interrupt his cash flow whatsoever. Again, puts himself on a system to pay himself back. He pays himself back probably within about a 3-month period. He's done this 3 times, to my recollection, all for business purposes to expand his business. Now he's in a situation where he has multiple vehicles that are out on the road, multiple crews that are doing their thing. He's generated more and more business, whether it's residential or commercial properties with the business that he's doing. He's expanded his business basically to the positive reality that he envisioned himself doing, but he did it through the policy of helping him with capital and not having to use the bank as much as we would normally have to do in circumstances of what I just described. He still had to use the bank maybe for an actual mortgage, but he utilized the cash position to offset down payments and not interrupt cash flow that was happening within his business at all. And all along, he's continued to increase cash position inside that plan. All the money is paid back. He made money in his policy at the same time he was making profit in his business. He made $1 become $2. And those $2 are all growing at different rates because of how much is he profit-wise is he trying to keep within his business versus this is a traditional business owner versus trying to expand his business. How much money do I pour back into my business from my profits to maintain what I'm doing or expand what I'm doing? He's done this in such an intelligent way. We've helped guide him through this, and this is what we talk about. This is not the only plan you want to have in place, but this is an unbelievable springboard and an unbelievable safety net to have it just like a home. You have to have a foundation to build that house that's going to collapse. This is kind of the same premise. We want to have a plan like this in place to keep the foundation of our finances in place to where they don't crumble down if something negative happens. He has something like this in place. It's not the only thing he's doing, but man, is this a fantastic vehicle to do what he's doing and still be able to do things for his family if necessary, for education for his kids in the future. He's using it for business purposes now. He can buy vehicles through this for not only his business, for his personal life. And you utilize your banking system and you pay yourself back instead of paying someone else. Quit losing the opportunity. That's the lost opportunity cost on that money well into the future that you cannot possibly imagine how much money you're losing. This is a fantastic plan as a foundation to do so many different things in your life.
Man, let's talk about that, because while you're telling us about Billy, what I'm hearing is the average entrepreneur out there. You've worked with business owners for years. I've been a business owner for years. And what Billy was able to do is to start a real business immediately because he had that money within his policy. He didn't have to, build out a business plan, take that business plan to a banker and beg them to give him capital to start his business properly. Or he didn't have to go through that sole proprietor stage where he was able to go out, hire employees immediately, and start a real business versus creating a high paying job for himself and working it into a business. I mean, I've done that several times. And what he's capable of doing with the cash value within his policy is time and time again bypass the bank, bypass the credit system, bypass timing, right? Having to wait on a loan, having to wait to get pre-qualified for a loan, having to wait on the funds to be released, and all these different, minute pieces of operating and owning a business that the average person doesn't think of. But I wonder how many of you are out in corporate America right now and you guys have the same dream that Billy did, where he wants to capitalize, where you want to capitalize on being an entrepreneur, creating your own wealth. And you're sitting in a position now where you don't know where you're going to get the money from. The way that Billy utilized this life insurance policy, from working full time, starting a part-time business on the side, putting money back into the life insurance, not even knowing that later on he was going to take that money out to start his business and change his family's life forever. Man, it's a powerful story.
Yeah, basically, I mean, if you want to really make this simplistic, what he did by delaying his start of his business full-time versus just part-time as a side hustle, because that's what it was a side hustle, basically. By doing this and then flipping the switch to making the decision, hey, I'm walking away from my full-time gig and I'm making the side hustle my full-time gig. And what he did in that interim between that decision and the time he got the policy, he in essence set up his own business line of credit. So think about when a business owner is doing that, they most of these individuals, depending on the business that they're in, but they typically have lines of credit to utilize as fail safes to keep the operations going, the flow of money. Think about receivables, account receivables, depending on what the industry is. It might take you a while to collect your money from your clients that you've done services or business for. Well, you need money to make sure that the business continue to flow. Well, if you don't have all your receivables in, these business owners depend on a line of credit to make sure that they don't go underwater and business maintains. Well, think about that. If you have a traditional line of credit, they're borrowing against that. They have to pay that back to the bank plus interest, whatever that interest rate's attached to that loan, and they never get access to that money ever again in terms of the payments that they're making back to that line of credit. It's gone. It's going back into the line, but they don't know it's their money is being utilized in a different way because you're paying a different entity. He set up his own personal line of credit in theory. So now he's borrowing for himself, paying himself back and the interest. So if depending on how it is accruing, I've talked about this with you before, Will, when you go to a bank and people are so fixated on interest rates and payments back, how much interest am I really paying? When you get involved in something like this, you start to ignore. That sounds ridiculous. You start to ignore the interest that you're paying because you're paying yourself. You're not paying someone else. So it changes the whole philosophy and mindset of how you view money. Because now everything is yours. You're utilizing your own personal system to make everything work. And you can get to a point where there's cash in that policy that you do not need the bank in any shape or form, period. Because as you build up and more cash is there, that line of credit keeps getting bigger and bigger and bigger and bigger. You didn't go get a $100,000 line of credit through the bank. Now you have a $500,000 line of credit because you've continued to make the growth keeps happening and there's just more availability to you. The sky's the limit. You talked about annual income limits when it came to the Roth IRA. It's also contribution limits to a Roth IRA. There's contribution limits to IRAs. There's contribution limits to 401ks, 403bs. These all have limitations. And I don't want to make it sound like there are zero limitations in cash value policies, because there are. We have to stay below what's called a modified endowment limit to make sure we don't have taxable events occur. But those limits are severely greater than anything you can possibly do in these other plans. High income earners, like you're saying, but just middle America that we talk to more than we do high end, like you're referencing a few minutes ago, Will. Middle America needs a way to funnel money that we don't have to pay taxes. We have to avoid taxation as much as possible. So when we talk about this, business owners are huge for this. We need to generate for individuals more passive income, meaning that you're just collecting money off something else that's working on your behalf. Real estate, as an example, that's passive income. You're making money off something else because of where their income is, the profit is coming from, in rents and those types of things. You're getting paid because you own the building, you own the property. That becomes a tax write-off as well, because there's deductions that happen. There's so many things that are available for people because you have a plan like this that gives you freedoms that you typically don't have otherwise. Now, those that are wealthy have a lot more freedoms because they just have more cash flow. But the average person is trying to find a way to get ahead and stay there, not get ahead, fall back, try to get ahead and fall back again, because their plans are on this roller coaster. It's up one day, down the next, up 1 month, down the next. We have to stop that process from happening. And that's all that's happening. I'm not saying you don't participate in those things, but man, your eggs cannot solely be in that type of a basket.
No, especially when we're talking, to your point, in the example of Billy, most businesses go out of business in the first 3 years. Then you've got a high percentage that go out in 5 years. You've got a higher percentage that don't last 10 years. And the number one reason these businesses go out of business is because of cash flow. That's the number one thing that knocks them out. And behind that, the fear of starting and operating a business, like Billy did, the fear is, what if it doesn't work? Well, if it doesn't work, you just owe you the money back. It doesn't totally just destroy your credit, destroy your lending opportunities, and just run you through the ground. Because with banks, everything is attached to your personal credit. So I've been there, done that. And if I would have known that these plans existed, I would have been in a way better position with cash flow when I had my other businesses and operated them.